Hey, what's going on YouTube? Welcome back. It's Travis here with JT Wealth. Now in today's video, I have a very cool subject for you. I want to show you guys and talk about a technique you can use in the stock market to beat the S&P 500 in a yearly basis by 20%. Now this technique works 82% of the time according to the research and statistics I found and I'm going to show you today. So I'm really excited about it. I got my blood, sweat, and beard shirt going on, and I busted out some scotch for the special occasion, so let's get into it. All right, welcome back. Thank you so much for joining us. If you're new to the channel, we appreciate you checking us out. Take a second for me real quick and just smash the like button and consider subscribing to the channel if you haven't already. It really helps out the channel on our growth towards that 100,000 subscriber mark, and I'm super excited to get there with you guys. And like I said in the intro, today's video, we are talking all about how to beat the S&P 500 by 20% in the year, and something that works 82% of the time. So that is fantastic. Considering the S&P 500 as it is has a historical rate of about 10% growth a year. So you're looking at a theoretical 30% growth in a 12-month period, assuming you follow this pattern, and like I said, 82% of the time. And before we jump right into what exactly that technique is or that strategy, don't forget, if you're looking to start a new investment account for whatever reason, check out the links to the different brokerages down below in the description section. For me, if I'm doing a dividend account or a long growth account, I'm an M1 finance kind of guy. I think that's a fantastic set it and forget it way to run things. My growth and tech stocks, I use Webull for. So if you're looking at anything like that, those are fantastic options for you. And when you utilize the links down below, it also helps out the channel. So I appreciate it when you guys consider those. Jumping right into what we're talking about today, the idea came from this article that came out yesterday, and it's out of Fortune. It says, anyone can beat the stock market, suggested by new research. So is it possible that ordinary individual investors without the help of ultra-fast computers or a PhD in math can reliably beat the stock market? Well, 60 years of Nobel Prize winning theory says no, it's not possible, but just maybe it is. Ironically, the widespread belief that it's impossible helps make it possible. To see how, recall a high buzz stock market event in December 21st when Tesla became a component of the S&P 500. Research affiliate chairman Rob Arnott and colleagues made a bold prediction. They said Tesla stock is likely to underperform the S&P 500 in the year after its entry. And Apartment Investments and Management, the stock that was replaced by Tesla, is likely to outperform the index over the next year by as much as 20%. Well, today, just over 6 months later, the only flaw in that prediction is it may have been too modest. The S&P 500 is up 17%, which is good. And Tesla indeed underperformed badly and is flat. The Apartment Investment and Management, known as AIMCO, is outperforming the S&P and by way more than 20%. It's up 44%. I pulled up both of those stocks charts just so you can look at them year to date. Mind you, we're missing about 9 days from December 21st to the start of the year. So year to date, Tesla is down 6.04%. But the company they took out of the S&P 500 to make room for Tesla is up 32.66%. All right, so that's one example of a stock going into the S&P 500 that doesn't necessarily do so well. Okay, and that one they replaced did better. But that's just one example, right? So let's look at a couple other examples. In addition, the S&P 500 components Broadcom, T-Mobile, and Lindell PLC will replace Allstate, Kinder Morgan, and Schlumberger NV in the S&P 100 index. Let's take a look at how that worked out. So again, Broadcom, T-Mobile, and Lindell PLC replaced Allstate, Kinder Morgan, and Schlumberger. So the stocks that left the S&P 100 are on the left, okay? The stocks that replaced them are on the right. Their year-to-date growth differences are significant. You're looking at over 10% difference between Allstate and Broadcom. Look at the difference between Kinder Morgan and T-Mobile. Kinder Morgan made 36.58% growth year to date. The company that replaced it, only 10.93. Schlumberger NV, 42.23% growth since they were removed from the S&P 100. Lindell PLC, only 13.02%. Guys, this isn't a fluke. This is something that is occurring in the ETF markets as a result of something that they call the index tracking. These index funds have to resettle every once in a while, right? And it happens quarterly, but they're so set on actually tracking a specific index and tracking the S&P 100 or the 500 or whatever that may be, that they're too afraid to have anything that's above or below that specific index set. So in the case of Tesla, the S&P Index Committee announced their addition a month in advance on November 17th of 2020. And for the next month, hedge funds and other traders bought it up, knowing they could sell it to the index funds that had to buy it on December 18th. Partly as a result, Tesla had already skyrocketed 57% in that month alone just from the announcement up until December 17th. Now, for Aimco, it was the opposite. Over that same period, the stock had fell 17% as investors were dumping it. But why do removed stocks outperform new stocks in the S&P 500? Well, according to the research of Wharton finance professor Dr. Jeremy Siegel, 82% of stocks that are removed from the S&P 500 go on to outperform the stock that replaced them in the index during his examination of subsequent 3-year performance of the stocks. Now, this finding seems counterintuitive. If a stock gets added to the S&P 500, it must be riding a momentum wave that it's seen valuations increase. And likewise, a stock that is removed from the S&P 500 must have been riding a wave of sluggish performance that warranted its exclusion from the index. So what gives? But they say this trading opportunity is obvious. You buy the outgoing stock, which has been pounded down, and sell the incoming stock, which has been pushed to the sky on the big day before that switch becomes effective. And those opportunities occur fairly often, about 10 times a year on average. And over the past 20 years, on average, of 23 stocks have been exiled from index annually to be replaced by 23 newcomers. So most of these deletions are practically automatic when a company merges, is bought, or goes bankrupt. The rest, and these are the ones to focus on, are discretionary switches like the Tesla Aimco. And those, again, are the ones you need to focus on. Now, it isn't necessary to follow the formula exactly, and again, you're only going to get it right 82% of the time. But individual investors may not own any of the incoming stocks to sell and may not have the stomach for short selling. So just buying the outgoing stock still works great on the average. The firm's research found that buying the outgoing stock in discretionary deletions from the S&P at the closing price on the day it is removed from the index has beaten the market by an average of nearly 20% for the following 12 months. And if you're unsure of when exactly the S&P index do their rebalancing, it is quarterly, and there's calendars for that, such as the one I Googled right here. You can see the S&P rebalancing in the yellow squares, March 19th, June 18th, September 17th, and then December 17th. All right, so it is July right now, which means the next one you have the opportunity to take advantage of is September 17th. It is also possible that the stock entering the S&P 500 index is near the peak point of its business cycle, while the stock being removed is near the bottom portion of its business cycle. But really, the eye-popping difference is about valuation. Each stock removed from the index is trading at about 0.46 times the valuation of each stock entering the index. That's a significant gap. The subsequent 3 years after the index reshuffling tends to incorporate the new stocks, seeing their valuation drift from 32 times earnings down to 20 times earnings, while the delisted stocks, the ones we're focusing on, recalibrate their valuation from 15 times earnings up to 20 times earnings. And if you are putting together a research list of value investments to consider, the corporations recently removed from the S&P 500 would be a great place to start. So there you have it, guys. This is something you can really pounce on quarterly. Set yourself up to know which stocks are being replaced in the S&P 500. Pick a couple that you like. And even if you're skeptical on it, don't put too much money into them, but give it a shot. Next time the S&P reshuffles, pick up one or two of the stocks they bump out and just wait and see what happens in the next 12 months. Remember which ones they replaced and then compare them at the end of the 12-month period. If you didn't make money, I would be impressed. Now, you know I'm a big fan of ETFs, tracking dividend stocks, tracking the total overall S&P 500 as a whole. But if you have the opportunity to reach out and try to get some proper 20% growth gains on top of that, as an aside, not your entire investment portfolio, but I think it's a fantastic opportunity. So I wanted to bring that information to you guys. But remember, this video and the information I presented in it is just for educational and entertainment purposes only. It is not stock advice. I'm not telling you what to do here with this kind of strategy. I'm just presenting it to you. Do some more research on it, figure out whether or not it fits into your risk tolerance, and if you apply it, do so under your own, that's your own personal choice. Lastly, again, thank you so much for checking out the channel. If you haven't already, don't forget, give me a big thumbs up and consider subscribing to the channel. And until next time, bottoms up.